Hello friends, hope you're all safe and doing well. The equity markets, both domestic and global, have had a fabulous run over the last 6 months. The month of February saw the continuation of the same trend, barring a few days of volatility in the last week on the back of increase in bond yields. The Nifty Large Cap Index rose 6.5% during the month, while mid caps continued to outperform, with the NSE Mid Cap Index rising more than 11%. Foreign institutional investors have continued to be net buyers of Indian equities. So far in this calendar year, FIIs have bought almost $5.9 billion on a net basis and into Indian equity markets. The market improvement so far has been driven by 5 key factors. Number 1, improvement in economic growth. Number 2, robust corporate earnings. 3, improvement in the COVID case trajectory and the start of the vaccination process. 4, global liquidity. And finally, the policy initiatives taken by the government, including the union budget. From here on, we believe that the markets are at an inflection point. After going into negative territory, real GDP growth in India has finally turned positive in Q3 with growth of 0.4% YOY. The GDP data is actually a reflection of the economic activity levels normalizing in India. This was evidenced by high-frequency economic indicators, which have been showing improvement over the last few months. For example, GST collections in January rose to an all-time high on a monthly basis. The composite PMI, or the Purchase Managers Index, has also recorded expansion for the 5th consecutive month. Early data for February shows that this trend has held up, with growth in power demand, e-way bills, railway freight, all remaining positive. We expect that economic growth from here on is likely to be led by a supportive mix of policy, both fiscal as well as monetary. With strengthening domestic and external demand, this should aid in revival of private capex over a period of time. More importantly, we are seeing the return of household capex, and this is evidenced in the improvement in activity in the real estate sector. The union budget, which was presented in February, outlined the focus of the government towards a more sustainable investment-led GDP growth trajectory with higher allocation towards capital expenditure. Corporate earnings has been one of the key drivers for the market so far. Over the last 2 quarters, corporate earnings trajectory has surprised positively, with net profit for Nifty companies recording robust double-digit growth after a considerable period of time. In fact, in Q3 FY21, Nifty companies have reported a net profit growth of 22% year-on-year, and this is after a 17% year-on-year earnings growth in the previous quarter. More importantly, the pace of earnings upgrades have been higher than that of downgrades, leading to improvement in consensus earnings estimates for FY21 and 22. Let's now have a look at valuations. If you look at valuations, it's true that on an absolute basis, the price to earnings multiple for the Nifty appears to be trading at the higher end of its long-term average multiples. However, on a relative basis, India's valuation premium to emerging market countries are at mean levels. Further, in the last 3 years, from 2018 till now, while the large cap Nifty index has clearly outperformed, it's up almost 40%, the mid cap index is up only 10%, and the small cap index is still below its 2018 levels. Now, with the market having run up so sharply, one cannot rule out volatility in the near term. However, we believe that as the pace of economic recovery picks up, the market movement would continue to get more broad-based in nature, with bottom-up stock picking being the way forward. While it is also likely that policy interest rates have bottomed out, we believe that the central bank would play a key role in assuaging the fears of a sharp rise in yields. As stated by RBI, policy stance remains accommodative, and hence any upward movement would be done in a very orderly manner in order to ensure least disruptions in the market. Core inflation, we believe, could remain sticky, but the headline CPI inflation would remain moderate and within RBI's comfort zone. Now, with this background, let me also discuss some key themes that we are positive on from an equity market perspective. First is manufacturing revival. The government's policy push is already seen in the budget, and the PLI scheme, which is the production-linked incentive scheme, is clearly pointing towards improvement in investment-related spends. On the supply side too, the policy focus has been towards removing bottlenecks. The labor reforms that were announced some time back are a step in the same direction. We are therefore positive on domestic cyclicals, which include sectors such as cement, industrials, infrastructure, and banks. The second theme that we are looking at from an equity market perspective is the real estate and the allied sectors. One key trend, as we were discussing earlier, is that of an improvement in housing and real estate sector. Now, this is also positive for sectors such as cement, building materials, consumer electricals. Some of the factors that has been driving the improvement in the real estate sector includes improving affordability, low interest rates, and the policy environment being supportive of the sector. The third theme is the supply chain shift away from China. As you all know, the PLI scheme is now being broadened to cover many other segments, the latest announcement being for the pharma sector. Fourth is market share shifts and the consolidation theme. This theme remains intact. Clearly, the organized sector is benefiting due to shift in market share from the unorganized space, and companies with strong balance sheets and cash flows are faring much better. And finally, the structural theme of financialization of savings and use of digital technologies remains to be key. In summary, from an equity market perspective, the revival of economic growth and the impact of the same in terms of corporate earnings trajectory would be the key variables to watch out for. There are key risks that we must be cognizant of, and these include the pace of flow of global liquidity, any rise in COVID-19 cases which could lead to disruption in economic activity, and also any disappointments in corporate earnings growth. However, if India continues to grow at a pace faster than what we have seen so far in terms of corporate earnings as well as GDP growth, the market momentum could continue. Our belief is that as economic growth picks up pace, the market movement would become more broad-based with focus on bottom-up stock picking. From an asset allocation perspective, given current valuations, we would recommend staying neutral on equities with a bias towards mid and small caps. Overall, we would advise investors to stay invested, follow a disciplined approach towards systematic investments into the equity markets with a focus on long-term risk-adjusted returns. With this, I would conclude now. Happy investing and stay safe. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.